Perfect. All right. Well, first off, guys, thank you for taking the time to hop on. I think in this market, there is just a lot of confusion and everyone, like, since I've been in this industry, I feel like people just love to throw out terms like appreciation and amortization and mortgage interest deduction and all these things. And we all kind of just pretend like we know what they mean and we don't necessarily do. So I always think it's helpful to just kind of get a refresher on it, but also a refresher for the market that we're in right now. Things that were relevant or strategies 2 years ago, even 6 months ago, might not be a strategy in today's market. And then also, if you guys are sending us clients, I think it's really helpful that you see what we are reviewing with your clients as well. It gives you, a better strategy and insight so that when we're tag teaming a client, we successfully get them into that home purchase or over the finish line with grace and ease. So hopefully this helps you get some insight there. Or if you are currently working with a lender who's maybe not doing all of these things, or maybe you have to ask them if they're doing these things to know, but just good information to see regardless. When we are doing a pre-approval with a client, the first thing we are talking about is really how do we make you what we call a bulletproof buyer? And so what that means is what can we do to be able to get you into a position where we want a buyer after they're done talking to us to go from unsure if they want to buy to I can't wait to buy. I'm so excited. I know the wealth that this is going to bring my family and I know what this is going to look like for us in the future. So that's our goal after they have their initial pre-approval with us. Right now, most of our clients, they're operating out of a place of fear. They don't even have the facts to be educated. And if they are getting facts, it's probably mixed information. It's coming from the news, it's coming from bits and pieces off Instagram, what their parents said to them, people's personal experiences that might not be relevant to them at all. So, our main goals when we go through this with them are to make sure they have a full picture and a full analysis of what's going on in the market for their specific situation, not across the board, not across the country, for their scenario. Make sure that they are fully underwritten without contingencies. We all know what it's like to get a buyer out on a Saturday afternoon and then they tell you they want to write an offer, but they want to have all of these extra things in place to protect themselves. We want to make sure that they're ready when they go out with you on a Saturday to write the most clean offer possible. I'm just going to mute some people here. And then appraisal gap strategy. Right now, we're not in a market where we're seeing issues with having appraisals come in low. But as we all know, come spring, we all of a sudden have that moment where multiple offers are starting to happen and buyers are totally on their heels. So right now, if we know someone is going to write in the spring market or is thinking about buying after January of this year, we are prepping them already with conversations of what does appraisal gap strategy look like? How long does it take you to break even on it? When is it a safe estimate? When does that feel risky? What does that really look like for you? And then additionally, if anyone comes to us and says, we want to write, but we want to write contingent, we dive in and make sure, do we understand what that really means? Is there really no options to write an offer non-contingent? Because that's the other thing in this market, maybe people can get an offer accepted contingent right now, but I think as interest rates continue to improve, we will slowly see less and less of that. So really important for someone to be prepared with all of their options. So we all know that real estate is not a get rich quick scheme. If you've been in the market long enough, you've seen, we've got some legacy people on here. Steve Elbers is on the call. I don't want to misquote, but you've been in the business for a long time. You've definitely seen people's values go down and then back up. But there's probably plenty of people who in that were held onto their property the entire time and were made whole. The point in buying a house is not necessarily to buy a house and then sell it for more money in 6 months. It's a long-term hold and investment that builds wealth over time. If you talk to investors who bought investment properties 15 years ago, 20 years ago, those are probably paid off and have tripled their value since the time they purchased them. Again, had they sold them at the wrong time or in a different market, that might not be the case. I always think this is really interesting to share, and I like to explain this to clients too. The Schwab Group did a study on the stock market that compares really well to real estate, and the stats go like this. Everyone, right? When you get into the stock market, you want to buy low and you want to sell high. That being said, you wouldn't really think of stocks as necessarily a long-term hold either. So this is just interesting, I think. But 6 out of 10 of the worst trading days in US history have been in 1 week of the best trading day. So picture if Friday is the worst trading day, maybe that next Tuesday is the best trading day. So if you had taken out your money on the wrong timing or tried to time the market just right, there are 10 days over the last 20 years that if your money wasn't in the market on those specific days, your rate of return, if you would have left it in for the 20 years, would be 8.4%. But if just 10 of those days you didn't have your money in the market over 20 years, your rate of return drops all the way to 4.2%. So half of the rate of return just from trying to time the market. So, I mean, I think that's really interesting just because everyone right now is, I'm going to wait till rates are low. I'm going to wait till home prices drop. Well, what's the phrase? Like if the best time to plant a tree was 20 years ago, the next best time is today. Same deal. If you're trying to time the market, you might be missing out on the best windows and the best peaks right now. If someone waited because they were going to wait till spring to get pre-approved to buy a house, we already have seen interest rates improve a little bit. You probably already missed your threshold and you didn't even know it. One thing that people always like to go back onto is appreciation over history. Everyone loves to talk about the housing bubble. The reality is, if you go back over the last 81 years, real estate appreciating and betting on real estate has been a 90% win rate. There is literally nothing else that you could invest your money into if you went back over 81 years that you could have a 90% win rate. What is 90% win rate? Meaning real estate has gone up over 90% of the time. If you look, you can see here that if you look here, you can see this averages out over decades what there's only a few times where real estate's gone down, obviously in the mid 2000s, in the early 90s, 2010, 2011 timeframe, we also saw some decrease. But if you still average it out over a decade, all the way through, if you average it out, we still saw positive appreciation. Does this surprise anyone to see? I think that sometimes we see these numbers and people don't realize that when we talk about 08, 09 and the housing bubble and all of that, like still over that decade, people did still see appreciation. Other major thing is I don't think clients fully understand, and sometimes I don't even know if we have the skills to properly articulate to them what is making this market so different right now. So here's just kind of a quick cheat sheet on exactly what's different about this market than where it was at before. Unemployment rate, the last housing cycle, meaning the last cycle where things went south, 08, 09, 2010 is what we're talking about here. Unemployment rate was 10% compared to now at 3.6%. Obviously, that's hugely different. But what's really interesting on these stats is we're looking at a delta in percentages, but we're not even comparing apples to apples on volume. 138 million jobs versus 161 million jobs. That's a 17% increase. So we have that huge increase, but yet the percentage of unemployed people is still so much lower. Subprime loans pretty much literally don't exist. I've never even done a subprime loan. I wouldn't even know how to do one, how to find an investor to do one. And I know very few people who do. Again, that was something that every mortgage person had access to and was doing before. Inventory and then mortgage delinquency, homes in foreclosure, all of these are significantly less than where they were at before. One of the biggest things that is contributing to this is back then, home builders were building homes rampantly, and also they were in way over their skis. They then didn't have the ability to hold on to a house till the spring market if it hadn't sold. They were giving away these homes, cutting prices on them, whatever they had to do to get rid of them, or going into foreclosure on them, which was highly contributing to the foreclosure rate. We just don't have that in today's market. You can look around the Twin Cities and see there just really isn't that many lots available homes to build. It isn't really that conducive to think that building is going to eventually catch up with the demand that we have in this market currently. This goes over, we can all talk about what happened historically, but this kind of goes over what's happened this year. Everyone said home prices are going to start trending down, and you'll see these are all the I don't know if people know this, but you'll see different data facts and different points across Case-Shiller, FHFA, CoreLogic, Black Knight, Zillow. These are kind of the main sources people go to. And you'll see, depending on how someone is calculating the data, that makes a difference in the outcome of the numbers, right? So it's kind of good to just look at all of the numbers, because if you look at just one, you might be slightly off. I mean, looking at 1.6 CoreLogic to 0.4 appreciation in March, those are pretty big deltas in numbers. So this takes all of them, averages them all out over 2023. And then the average pace we're saying homes have appreciated at is at 7% this year. 7% is really good. Everything I'm going to show you moving forward, we are averaging out historical appreciation for Hennepin County when I'm showing you these numbers, which is typically between 3 and 4%. So when we're talking to clients about this, we're showing right now, this is where the market's at, but I want to show you worst case scenario, how the numbers still make sense and work for you as we go through all of this. And then also interesting to note, we're still seeing these appreciation, and all of the yellow boxes are all-time highs in real estate values. So we're still at an all-time high, and we're still hitting the appreciation, which if you watch CNBC, you would think that's not the case at all. Okay, one of the things your clients, so moving through the rest of this, we talk on a lot of these things. I am not killing your clients with all of these individual details unless they want me to, or unless they're getting really analytical of questions, and I'll pop up one of these charts. These next charts and these infographics are things I'm going through individually with every single pre-approval that comes through. So for those of you who don't know, or maybe haven't had a transaction with us before, when a lead comes in, either Shannon or myself, Shannon's my team lead, and I are talking with them on the phone. By the way, it's funny because I always say Shannon is my team lead. It is actually just Shannon and I. So there's really just the two of us kind of tag teaming each individual client. But either Shannon and I talk to them over the phone first. I am not going to launch them off to a website and say, here, give me all your private information, and then I'll tell you what you qualify for. No, we want to understand, why are they purchasing? What price point do they really want to purchase in? And where did they come up with that price point? Yeah, maybe they have money for down payment, but maybe they're stressed about credit card debt. We want to deep dive into all of these different nuances with them, so that when we pull together this information and create loan options and go through scenarios with them, we're taking their whole financial picture into mind, not just what they qualify for. Huge difference. So after we do that, then we've narrowed in on a neighborhood they likely want to purchase in. And then we go through one of these. This is called the real estate report card. We can pull this for any area, any zip code, anytime. So if you ever want to utilize one of these for your clients, feel free to just DM us, send me an email, text, whatever, and just ask for a real estate report card is what this is called. The key thing we go through with every client on here is this section. Right now, there are 108,000 people in this area who can afford to purchase and are currently renting. Again, 108,000 people. There's 428,000 other renters who can't afford to purchase right now. What happens when interest rates come down by 1%, by 2%, and all of a sudden that 428,000 people can all afford to purchase. I know most agents are out there preaching to all of their buyers, to their Instagram followers, and to everyone else, when rates come down, more people are going to buy. But a lot of these clients, they need to see actual numbers and statistics to prove and understand this information. And that's exactly what this does. It is very crystal clear. As rates come down and affordability increases, we have more people who want to buy, and then we have more people offering on the same homes. And then here we're forecasting this area's appreciation value. So you can see, depending on purchase price, all of that. And then historically, the 5-year, 10-year, 63-year averages on appreciation. I don't even know how many times we've heard it. I'm sure buyers agents have heard it. I'm going to wait till spring. I'm going to wait till rates come down. My dad told me, always your dad. It's always someone's dad has told them, I'm going to wait till home prices come down. My dad told me we're in a bubble and I need to wait for home prices to come down to purchase. This is why getting this information in front of clients is so important, so we can help them make a real educated, factual decision and not their dad's opinion of the market decision. No offense to any dads out there, but that's just typically, it's always a dad who kind of kills somebody's dreams. But so this is a real scenario that we're running for clients. We're pulling in their purchase price. We're putting in their down payment amount, the interest rate we're showing them. All of this would be real time for the client and going through with them. Okay, so this is where we know your loan is at today. If you wait 6 months, interest rates might come down a little bit. If you wait a year, heck, they might come down a full percent. We base these percentages off of forecasted where we think rates are going to go from other external sources, not us. If a client is convinced interest rates are going back to 3, we will absolutely run these numbers and put a 3% in here. It's whatever they are comfortable with. And you'll see here, just waiting, even when rates are going down, it breaks out the down payment. If homes are appreciating, obviously you have to spend more money out of pocket. So right there alone, it's going to cost you more money if you wait a couple of years to purchase. When you look at one of these graphs, I think it's a lot of people talk about appreciation and amortization. As a refresher, I think of amortization as money in your savings account. You're putting the money into the home, you're paying down your own home that you own, kind of like a savings account. You're putting it away for a rainy day. Think of appreciation like your checking account. You get money coming into you that you didn't, well, you probably worked for it, but you didn't do nothing for it, but someone's giving you that money. Same thing with appreciation. The market is giving you that money as your home increases in value. So every time you're waiting to purchase, your amortization, this is how much you lost on what you didn't pay down of your mortgage. And this is how much you would have lost based off of how the market continued to appreciate. And so that breaks out for waiting 6 months, waiting a year, waiting 2 years, waiting 3 years. So yes, there's also this cash flow of, we'll look at the cash flow next, and then the cost of waiting, it adds it all up here. So the difference in monthly payment, the difference in appreciation, the difference in amortization. Someone's waiting 3 years. This person's scenario out of, I think it was a $450K purchase price, that's $70,000. That's someone purchasing a $450,000 home is probably making $70,000 a year. So they would have to take their whole before tax earnings and essentially throw it out the window if they want to wait to purchase. When people can see these real-time scenarios for them and their money, it makes a huge difference in wrapping their head around it. Again, if you guys have clients who aren't working with us and you just want to show them this, I'm always happy to run a cost of waiting scenario for anyone as well. And then the last part of it, it just models out how much more is required when you're purchasing and then what it's costing them monthly and annually if they're waiting, just on cash flow, not on the amortization or appreciation. Does anyone have any questions on this? Good. Okay. This is a lot of data. And so at any point in time, please interrupt. I would love someone to ask questions if it's not quite adding up. So we know rates are high. We know rates are cyclical. We don't know when interest rates are coming down. We don't know what they're coming to, but here's stats we do know. We do know that last time inflation went up 7%, not last time, 2 times ago, 7% to 14%, mortgage rates went up. Then the Fed raised the Fed funds rate to get inflation to respond, to get inflation lower. Then mortgage rates respond and went lower. And then we went into a recession. Same thing here. Inflation increased from 1.75 to 3.5. Mortgage rates increased. Fed funds rates go up. They bring down inflation. Mortgage rates respond. We go into a recession. Same thing here. Current scenario. Inflation has significantly increased. Mortgage rates have significantly increased. The Fed fund rates obviously have significantly increased. Inflation has come down. As inflation declines, we should see all these numbers balance out. Will this put us into a recession? Home owners and people who don't fully understand the economy and the market, a recession totally freaks people out. A recession doesn't have to mean it's a bad time to buy a home at all. If you look here, home values have gone up typically during a recession historically, all but one time. This one time is when we were doing subprime loans, when the builders were over their skis, when we had a huge tick up in values, and then we had the combo of the builders and the subprime loans and builders going into foreclosure and all of that. That is the only time in history that we've seen home values decrease during a recession. So that is not something we expect to happen by any means of the imagination. Right now, the market that we're in, we know is a little bit different than what might hit in spring. And I think that 95% of realtors don't actually understand how a 2-1 buy down works or what you can do with seller paid closing costs right now. So right now, and this is again a conversation we're having with clients, if you get out there now and start looking when you might be able to negotiate seller paid closing costs, we can save you a ton monthly now. Come spring, interest rates might go to 6.5%. Everyone's going to be in multiple offers. We might not be able to save you that money then. So this is what it looks like. On a $500 purchase price, if someone puts $50,000 down at a $450 loan amount, today's rate, let's say it's at 7.125, that brings you to a principal and interest payment of $3,031. We asked the sellers to do a 2-1 buy down. That means they're paying the difference in the principal and interest payment for the rate to be 2% lower the first year, 1% lower the second year. They're not actually paying the full mortgage spread. They're paying the difference in payment, which is why your dollars go so much further with a 2-1 buy down than asking the seller to pay discount points or using the closing costs for discount points. If you used a full, if you use the same amount to buy discount points, it would probably get you to, well, we'll look at a couple of charts exactly what it would get you to, but total, we're using $10,000 here. So the first year, we're lowering the payment by $581 a month. That is a lot a month in savings. If you have a buyer who is worried about their monthly payment and you think you can take them out and get 3% in seller paid closing costs, they could save in this scenario $581 a month for the first year. The second year, it's $297 a month for the second year. Everyone is so confident that interest rates are going to go down. So whether that's in 1 year or 2 years, well, anytime in there, we can refinance you. And that money that was put into the holding account to pay down the mortgage difference, that just gets credited towards your principal balance. So it's no money lost versus a discount point. If someone is permanently buying down the interest rate with discount points, that is money out the window if you end up refinancing in 6 months. And so that in this scenario, it costs the seller or, with seller paid closing costs, it costs $10,500. 3% seller pays is actually $15,000. So if someone could go out right now and get 3% seller pays, which we're seeing all the time, they could use 10,500 of it to save all of this a month for the first 2 years, and they would still have $4,400 to help offset the taxes and insurance or any other closing costs, home warranty, whatever the case might be. Any questions on this? I feel like the 2-1 buy downs is something we get a lot of questions on. People are just kind of unsure of them. One question we're getting a lot of too is, how do I write a 2-1 buy down? Like, what do I put in the purchase agreement? It's just seller pays. It's nothing weird. It's nothing crazy. You're just asking the sellers to cover concessions. So the next question then a buyer is going to ask us is, okay, well, we always prep them too. If a home is listed at 400,000 and you're going to ask the sellers to cover 3% in seller paid closing costs, then that's going to cost them $12,000. So maybe you're actually going to offer $412,000 and ask them to cover the $12,000. You're like, well, is it bad to bid over ask or to pay more for the house than it was even listed at? This is always a confusing conversation too, because we know sometimes an agent messes up and they listed something lower than they could have. And it's, there is more value there. Sometimes that's their strategy, is to list low to drive it into multiple offers. But to explain that all to a client and for them to just like believe it is a little bit tricky, right? And so we actually have a tool where we can run for the specific house based off the forecasted appreciation, what the break even is if they bid over ask. So in this scenario, I did, if they are at a $450 purchase price, they bid over ask by $15,000. So they're going to find a listing that's $450 and they're going to make an offer at $465,000 and ask the sellers to cover their closing costs so they can do a 2-1 buy down. It takes 7.6 months to break even based off of the historics we expect in Hennepin County based off appreciation. So 3.76% in the first year, so on and so forth. If you need somewhere to live and you are buying a house and you don't want to be in a spring market crazy frenzy, it breaking even in 7 months, if you're going to live there with your kids for the next 10 years, that's a no-brainer. You still can see the appreciation is still there. You're still making a lot of money off of your investment regardless. Likewise, if, we're in the spring market and all of a sudden 450 turns into 500,000 offer price, we can still run this for someone so that they can understand, hey, I really want to be in this house. This is the house my kids are going to be born in. This is the house I'm going to retire in. Whatever the case might be, we can help them understand where, is that bidding over ask realistic? Is it a good, healthy financial decision? Again, just good tools to be having your clients run. Ahead of that Saturday afternoon panic, we need to write an offer today. We're having these conversations with them before that. Renting versus buying. Obviously, not everyone is a renter, but this really hits home for first-time home buyers. Depending on when you grew up, I'm 33. And when I was growing up, I was raised that you bought a house because owning a house would be less expensive than renting a house. If you are 25 and you're purchasing your first home and interest rates are over 7%, owning a home might not be less expensive right now, monthly wise, than renting. And so I think we kind of miss, you encourage, you've got a friend, you've got a neighbor, whoever, and you encourage them to get pre-approved. And then they get pre-approved, they see the monthly payment and they totally panic. You can talk to them about appreciation, all of those things, but it's not tracking in their head how it would be a good idea. Because if you're going to spend more every month to own a home, well, why don't you just take that money and put it in savings? And so to show them this really helps, again, for their specific scenario. So in this scenario, someone's paying $2,200 a month in rent. Their monthly mortgage payment would be $2,827. You can see here, if we compare year over year, well, we all know that your rent is probably going to go up at some point, but your housing expense will not. So that shows their housing expense year over year, and then their rent eventually goes up. Maybe that's not enough of a reason for everyone to purchase that's kind of further out before you would even see the benefit. And so here's another scenario, which is really what typically entices people. This is us assuming that when they sell their home, they're going to pay 6% in real estate commissions. And this is what they would net after the fact. So of course, in year one, if they buy their house and then they turn around 2 months later and they sell it and they have to pay 6% in real estate commissions, that would not make sense. They would lose money. Maybe the realtor would give them a deal. I don't know, but that's not going to make sense. But when you start looking at it further and further out, well, okay, you're going to buy your starter home now, and in 9 years or 7 years, you have an older family and now you want to buy that dream home. This is what this looks like. After selling your home, you will get a check for $285,000 when you walk away from the title company. That's really a significant amount of money. For a first-time home buyer, they can't even fathom how they're going to save $285,000 after their paycheck in today's economy. And so seeing that they can do that and build wealth through where they live is really, really incredible. As you are talking to loan officers and hearing the news and trying to track what's going on with mortgage interest rates, you will hear people talk about basis points and market movement. And it's nearly impossible for most people to understand what any of it means. And so I thought it would be really helpful for me to actually break it down. When we have a pre-approval or a real deal or, whatever the case is, we take a lot of information to price the interest rate. We take the purchase price, the loan amount, the county they're purchasing in, their credit score, their debt to income ratio, their income limits. If they're below a certain income limit, if they're above a certain income limit, if they're self-employed, how many months of reserves they have after they purchase the home, meaning how much do they have left in the bank after they buy their house, and debt to income ratio. I don't know if I said that one already. So we take all of that information. So when you have a client who is like, oh, I saw this right here, so-and-so quoted me this, so-and-so quoted me this, it's not because everyone's rates are that much different. It's because maybe one lender just posts their rates and they saw that and they didn't take any adjustments into account, or they priced it on a different day and the market's always moving. All of these things can be huge swings. So I thought it'd be helpful for me to actually show you what we look at on our side. So just this morning, I took I forget what the loan amount was, but I took a loan, I priced it out, and here's all of the different things it can price at. A par rate is 100. That means we are making enough money on the loan, but not too much on the loan. Anything below 100, then we're asking for the client to pay what's called discount points. You can see there's not an even spread between any of these numbers. So 99, that would mean I'm asking the client to pay one discount point to have their interest rate be 7%. If I was at 7.5%, I would actually give them a lender credit because we're over 100 of $552. But none of these are evenly spread. So when a client is discount points, no discount points, what if this makes sense? It's always different and it's completely specific to the client. If I reprice this same loan and I said this client makes over $140,000 a year and their credit score is 680, all of a sudden, all of these numbers would be at 97, and I'd have to be pricing them way up here because these investors don't want the loan. You can see each of these names is all different investors that were available for best pricing at this interest rate. And so then we click through and figure out who is the best investor with the best interest rate for that client's specific scenario. Hopefully that's helpful to just kind of see behind the screen. I feel like everyone talks about these things, but no one actually ever shows what they mean. Actually, don't even know if I'm supposed to show that. So hopefully I don't get in trouble. Market movement. This morning, I pulled this earlier today, real time, what's happening in the market. If a box is green, that means the market opened on the bottom, improved that day, and the top of the line is where it closed, meaning the long vertical boxes. This is movement every single day back to beginning of September through November. This is a lot of market movement. If I would have opened up this chart, same chart for you 5 years ago, it would have looked like a tiny little dot plot because there's almost no movement ever. There was not enough to even affect interest rates at all. If your clients got pre-approved at the beginning of September and then waited to start making offers until October and then got an accepted offer, canceled an inspection, and then all of a sudden they're under contract again in October. I mean, they've seen a lot of different interest rates. That's really, really scary for a buyer. They need someone to walk them through this, but most importantly, they need someone who understands it, who's going to lock them in at the best point in time. If you were working with by the way, down here, this is another chart, and essentially what it shows you is the market responding based off emotion. So this is saying we're outside of the norm. This is how outside of the norm things are. When it's trading way down here, it's very emotion based in the market. When it's trading here, that means we're in a healthier place. If someone doesn't know how to read this and someone got an accepted offer on October 15th and right now, and they locked them at 7.875 and they don't close until the end of December, and now rates are at 7.125. That's a huge miss for your client. People need to know these things, be watching, and your clients feel so much better about their purchase if they're being empowered with this information too. No, I fully understand not every client wants to know any of this information. Some of them want none of this information. We just like to Some of them will just talk through it high level. And if they're asking questions and they're interested, we'll deep dive into it further. And we flat out ask them up front, how much of this information do you want? What is your knowledge level with all of this? Have you been pre-approved with other lenders? Are you shopping around? What does all of this look like? I want to make sure we're not wasting their time by just rambling stats at them. We want to make sure we're making an impact where they're concerned in the market. This is probably the biggest eye opener for clients. I know I've sent this to some agents too. Now we run it on every single pre-approval. We run kind of the middle of the price point someone is looking in on their loan amount, their taxes, insurance, the whole thing. And we show them for every eighth of a point that interest rates move, we're talking about $30 a month. A lot of people spend more than that at Starbucks a month, right? Is $30 a month over 30 years nothing? No, I don't want to mitigate it, but it is nothing that is going to ruin your life or prevent you from buying a house. And I think what happens for people is they start buying a house or they start thinking about it. They start watching the news. They start listening to their parents. They start seeing on Instagram, rates went up, rates went down, rates went up, rates went down. And it puts them into a total analysis paralysis where they don't buy anything. When really rates went up maybe an eighth of a point, that's $30 a month. That is not something to not buy a house over. Okay, points versus no points. So earlier in that chart, remember where we said $10,000 in seller paid closing costs, where it got you to? Actually, I'm going to go back to it. So let's see. On here, if we were going to have someone spend $10,000 buying down the interest rate here, it would get them to about 6.5%. I don't remember what I guessed, but I feel like I was almost spot on. So let's say it gets them to 6.5%. Remember that same 2-1 buy down would get them all the way down to, I think it was 5.125%. And with a 2-1 buy down, you get that money if you refinance in 6 months, 9 months, a year. If you buy down your interest rate in December and you refinance in August, you do not get this $10,000 back. It is money out the window. The investor keeps it. So discount points are no points. Also, we are running this chart for every single client. If you do not pay points in a general scenario, let's say it's at 7.875, and with a discount point, it gets you to 7.375. Again, the discount points are the margin between the interest rates. So the more money you pay in discount points, the lower your interest rate would be on that chart. The less money you pay, the higher it ends up being on that chart. And so in this scenario, you have a lower interest rate, great. your payment is $124 a month less, but it takes you 29 months before that's actually savings because you have to break even on the discount points, meaning the money you spent up front to get that interest rate. Well, if I think you're going to refinance in August or September as we lead into the election, why would I put you in a mortgage where you're never even going to break even on it? Shouldn't even be an option. Here's a perfect example of what's being marketed to your clients. I just pulled this right before we got off, or right before we got on this call. This is from Quicken Mortgage's website. If you Google Quicken, I always just do Quicken Mortgage because they kind of promo the cheapest rates. It's the same thing on Rocket Mortgage or whatever. Literally just Google Quicken Mortgage interest rates, and it'll give you this chart. Oh my gosh, they're offering me a 7.375 interest rate, but they're offering it with 1.875 in discount points. Well, heck, if it takes me 29 months to break even on one discount point, 1.875 discount points, that's going to take me like 29, probably almost 40 months to break even on this. That would make no sense. A lot of times clients ask, do you have any lender fees? This is not a lender fee. A lender does not have to disclose this as a lender fee. It is a fee to the investor for buying down your interest rate. It's not a lender fee. So when they ask that, they say, no, we don't have any lender fees. That's not what the client is asking, and they know that, but that's the response someone would get. Are you paying discount points? Yes. So how does someone tell or watch for this? The APR. So you can see the APR is 7.668. If someone wasn't paying discount points, the APR would probably be 7.378, or it would be very, very close to that same number. Joseph just asked, can you get the money remaining back in a 2-1 buy down if you refinance within 2 years? Can you refinance with any lender or with the lender you bought the home with? You can refinance with any lender. If you do your mortgage with me and you do a 2-1 buy down, and you're like, oh gosh, that girl was so annoying. I hated her great customer service and her good communication and all the education she gave me. I would much rather do my loan with some chop shop broker shop. Totally fine. You can refinance with anyone. That money it's put into an escrow account that's managed by the loan servicer. And once you refinance, it is just paid towards your mortgage. So you're not going to get a cut check back. It's just going to go towards your mortgage. Good question. Any other questions on the interest rate portion or how that comes together with discount points, no discount points? Nothing. Going back to kind of the market we're in, all of those things, we've seen the stats on where interest rates are headed. We've seen how that's going to pivot up buyers. We know the inventory issues. We know everything else. Again, if you haven't done a deal with us and you don't know, we do a full underwrite and pre-approval of the file upfront. If I say they're pre-approved, these people are set and ready to go. And so to put our money where our mouth is, we personally, this is not Novus, this is me personally saying, if we did not close the loan on time, we will give the sellers $10,000. I know, so this has been kind of a thing that's been around before. A lot of companies have done away with it. I just think it brings a lot of validity to a listing agent to help set our offer apart. And we always, again, reminder, if you're making an offer, CC us when you make the offer so we can call and tell the listing agent about this and make sure they fully understand it. And then also, any client who's purchased thus far while rates are up, any client who purchases while they're still higher, we're calling it our refi protection program, meaning they will pay no lender fees and will cover the cost of an appraisal when they refinance. We're talking $2,000 in cost. It's not $100,000 in savings or anything crazy. But when a client hears this, it's literally like someone took bricks off their shoulder. What their fear is that they buy now and they get nickeled and dimed and told they can't refinance in 6 months, or told it's going to cost them, for some reason, clients always seem to think it's going to cost them the same amount of money when they refinance as it did when they purchased, even though they're not bringing down payment and things like that, but they don't quite grasp that sometimes. So talking about this with them gives them total peace of mind that that's our end goal for them. We're going to try and set them up to refinance as soon as possible. If rates drop 20 days after they close, I will be the first person calling them saying, great news, let's refinance you, assuming all the other numbers make sense too. But just a good point I wanted to touch on as well, as you're having conversations with buyers, sometimes they don't even know to articulate that this makes them nervous or that they don't understand what a refinance is. Most first-time home buyers have never refinanced anything. They have no idea what that would even mean. So really important to make sure to have that conversation too. What questions can you guys think of? Anything else I can run through? I'm gonna go through here. Claire, Jean, Haley, Kelly, Kate, anybody? Any questions? Caitlin? Anything else I can go through? Does it make sense in how the rate portion of stuff all comes together? Let's see. This is super helpful. You're welcome, Caitlin. Okay. Thank you, Lauren. Thank you for asking this, because this is seriously what clients want to do. They're like, yeah, I have no idea. What does it mean? Okay. When someone refinances, so they buy something with me and they close at the end of November, they close tomorrow. I'm saying rates are coming down before election time. So we're going to put good vibes into the air. It's September. It's my birthday month and people are going to refinance and I get to call people with good news. Rates are at 6%. Maybe we're going to go with 5.5%. I'm going to call them and say, hey guys, rates are at 5.5%. I absolutely think you should refinance. Here's what you'll save. Here's why it makes sense to refinance. Can we get rid of mortgage insurance? All of that. We're giving them a new mortgage with new terms, completely new terms. They say, yes, go ahead. I said, great. Has any of your information changed? Yeah, I make $1,000 more. Or, yeah, I got a new job. Perfect. Where do you work now? We'll get that updated. We go through the system. We get all of their stuff updated. They don't have to do anything at that point. We get a few documents to support that what they told us is still true. Pay stubs, W-2s. Usually on a refinance, we don't even need tax returns unless they're self-employed. Pay stubs, W-2s. We don't even need bank statements, a copy of their driver's license. We submit it to underwriting. We find out if we're trying to use a higher value to get rid of mortgage insurance, sometimes we will order a new appraisal. Their house doesn't have to be squeaky clean. It's nothing like that. It's just someone going out to double check on where we think the value is at for the finishes in that area. If we don't need an appraisal, literally we send to underwriting, we get it out, we get updated insurance, make sure everything is set, we schedule closing, they go to the closing table. If we do need an appraisal, we just wait for the appraisal to come back after we order it. Again, we're covering the cost of that. When everything is done and clear to close, we reach out to them. Hey, do you want a closer to come to your house and sign it? Can you swing into Edina and sign Thursday at 4? What works best for you? They sign, they get to skip one payment, no different than when you purchase. You have a 1-month break in payment, and then your new mortgage starts after that. If someone purchased with us 5 years ago, we might talk about a 25-year refi. We can even do a 27-year if they're in the in-between. Otherwise, if they just purchased recently, we would do a 30-year mortgage likely, unless they want their payment to go up a little bit. And then when they refinance, they typically create a new escrow account, and then they get the balance of their old escrow account returned to them. That money ends up being a wash, obviously. And any of that, typically we're just including into the mortgage. Normally a client is never bringing any money out of pocket to a refinance. They are just showing up, pen in hand, ready to sign. So many folks renting. Thanks, Claire. I'm happy that you hopped on. I think especially, I know a lot of you on here deal with a lot of first-time buyers. Claire is one of my favorite to work with because she'll always call and ask questions and make sure she's educating people correctly. Please call me, guys. I am so happy to run through things and explain things. I don't ever want any of this to be a misnomer. Claire can attest, if you call me, I will call you right back or answer right away. And I am overjoyed to run through any of this information with you. Even if it's not my client, if it's going to help you guys out, we want to add value. Please lean on us as a resource. Any other questions anybody has? Nothing? Well, I'm glad hopefully this was helpful. I do have it recorded, assuming I did that correctly. And so I think you'll receive a copy of it as well. Again, if there's ever any of these reports that we can run for your specific clients, please let us know. If they're pre-approved with us, we 100% of the time are going through this with people. Can you explain the 10K pre-approval guarantee for the sellers? The deal falls through. Yes. So if the deal falls through, meaning they're, they backed out or there's an inspection issue, that does not earn them $10,000. It is only if we can't close their loan. They don't qualify. We messed up. We didn't get, we didn't do the underwriting in advance. We didn't know they were self-employed. We didn't double check their W-2s and see that they actually have variable income. They said they were salaried and they're not. We are guaranteeing that none of that is going to happen. And when I articulate that to a seller, I'm saying like, this offer is as good as cash. We've verified everything. We've seen it all. Besides an appraisal, this loan is ready to close. You want to close in 10 days? Let's do it. Would that get written on the PA? Most of our agents would, sometimes they'll write it up. Ooh, I'm trying to think if anyone's on here that does this. We have a couple of our agents that essentially write it. How do they say it? We always include it with the offer. So when you get a pre-approval letter from us, it has that, it has our closing guarantee, and it has a lender questionnaire. The lender questionnaire explains all the documents we've seen and kind of goes hand in hand with the closing guarantee. When people write it out, they oftentimes write it like financing guarantee. They like kind of spell it out a little bit in the purchase agreement, but they for sure always include the closing guarantee when they write an offer. And then anyone I work with knows, CC me. I will call the listing agent as soon as I see that purchase agreement come through my inbox. I don't care if it's, well, not past 9 o'clock on a Saturday, because I'm usually sleeping at about 8:45, but I will call them bright and early the next day if it comes in later than that. We are always 100% going to call. It always sets the offer apart, and likely I've done a deal with that other agent or they've heard of us in the past, which always helps hopefully get an accepted offer. 5 days or any time before closing. Right in 5 days or anytime. I think anytime before closing. And then also I would always recommend putting market rate if that's an option versus putting the interest rate in there. I've seen listing agents, when someone puts an interest rate in there, they'll put like 7.5% because that's what their client was pre-approved at. And the listing agent's like, what the heck? Are they trying to have an easy opt out here? Because what if rates went up? Do they not qualify past 8%? Or what does that mean? So I always think it's best to put market rate in there, or that's been my experience, or put a rate way higher than where rates are at. What other questions can you guys think of? Anything? I think that we're, as we get into the spring market, going to see more and more of the appraisal gap stuff. I think that tool is a huge resource. And the bidding over ask, it totally freaks out clients. If this is your first house and Miss Erin goes and shows them a house on a Saturday afternoon, she's like, cool, so this is listed at 409. I think you should offer 459. I mean, holy gut punch. That's not what they planned for, right? It just totally changes the game. Important for people to understand what that looks like and that it's going to be okay. It's not like they wasted $50,000. They're going to gain it back in appreciation. It just takes a little bit of time. Perfect. Well, thank you guys for hopping on. Steve, thanks for being on too. If there's anything I can ever help with, of course, reach out. Otherwise, oh, and one more thing. For those of you who are right here in the metro and want to join on December 13th, we are hosting a Q&A with Sarah Schultz, who is a branding expert. She's really incredible, really focuses on how to put out content, information, branding to match what your dream client looks like, whatever that is for you. So we're going to do an hour-long Q&A with her. And then afterwards, we're doing a fun little social. I joke, I literally haven't done anything fun because I've been working my butt off all year and having a baby. So this is the first time my team will do anything happy hour related all year long. So December 13th from 12 to 1 is Sarah Schultz. 1 to 2 is our little happy hour thing. And then it's at Mr. Paul's Supper Club in Edina. I will make sure everyone on this call gets the like formal invite to it, but please, 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 I'd love for you to come. Yes, we do Minnesota housing. We are one of the #1 lenders in the state volume wise for Minnesota housing. We do a ton of it. In addition to Minnesota housing, there are other great options for first time home buyers right now. We have a 1% down, 2% grant, no mortgage insurance program. If they're purchasing under a 370 purchase price, that blows Minnesota's housing's program out of the water. Absolutely would recommend it to a first time buyer right now. And then also as a reminder, we are doing a lender paid temporary buy down for anyone under contract before the end of the year. So if you have anyone who just gotten an accepted offer or anything, you know, close to that, or is looking in the next couple of weeks, I would love to give them a second opinion. Essentially, we're doing that 2-1 buy down, but just the first year, and we are covering the cost of it. It is my personal way of trying to help people get under a contract and not wait until the spring market when things are wild and crazy and they get discouraged and end up not buying anyway. So if you or anyone in your office has someone under contract before the end of the year, there is not an offer in town that can beat it. Please, please, please connect them with us. We'd love to chat with them. And if anyone on here, does anyone on your team speak Spanish? We have people internally that speak Spanish, but myself and Shannon personally do not speak Spanish. But if they needed translation help, we absolutely can get that. And we do have all of the loan documents, all of that type of stuff in Spanish as well. Good question. We actually did have a Spanish speaking person for a little while, and there was literally no one ever. Everyone Spanish speaking has like a child that translates for them, or they know enough to get by and they don't really need the translation. And so we ended up literally never using the service of it, which, you know, you figure it out over time. But yes, I would be happy to take on Spanish speaking clients as well. Awesome. Thank you guys for hopping on. Have a good rest of the day.